Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his
Here's the Sandman.
over Sandman.
Before you go out and order your turkey, there are a few things you can do to keep your taxes down, but you have to do it before the end of the year. Good morning. Welcome to Protect Your Assets. I'm David Hollander, your host. It's great to be with you here this morning. For those of you just joining us for the first time, welcome. People around here, they call me the Sandman. That's because I help my listeners sleep well at night by protecting more of you, what you work so hard for. That's because we answer tax, legal, and financial questions each week. And that's because I've been running a tax, legal, and financial firm for over 30 years. So the big, beautiful bill is now law, and there are some great new tax deductions that you can take advantage of in 2025. So if you have a question about what maybe you can do before April 15th, feel free to call me, because 2026 is just around the corner. Before you know it, we'll be eating turkey, having Christmas, and then it's over. And this big, beautiful bill, which is now law and actually has some great new tax deductions that you can take, some smart money moves that you can make. We've been talking about that at our workshops, have been sold out. Well, you should consider making some of these moves right now if your goal is to pay less taxes next year. Don't wait till the last second. Learn what you should be doing now to make your money work harder by year end, as we share year end smart money tax moves to make before it's too late. It's all coming up next. Now let's get started. Well, the U.S. government shutdown is over, and it looks like there may be a stock market rotation going on. The Dow Jones Industrial Average for the week had a great start, but finished off just up 0.3%. Year to date, up 10.8%. S&P 500, same thing, finished the week up slightly, up 0.1%. Year to date, up 14.5%. NASDAQ, that's where the pain was, off about 0.5%, even though we had the volatility this week. Year to date, up 18.6%. The star is still the international index, the MSCI EAFE index, up 2.8% this week. Year to date, up 26.1%. Wow. And the 10-year Treasury moved a little higher with concerns that they may not raise or lower interest rates here in December. So that rose to 4.15% on the 10-year Treasury. And oil was up slightly, 0.4%, closing off the week at $59.96, getting real close to that $60 a barrel. So after 43 days, the longest U.S. government shutdown came to an end on November 14th, and that means you can go back to the airport and most likely not have to worry about your flight being delayed or canceled. That happened to me last week. How about you? But it's not over. The Affordable Care Act, the ACA, health care premiums are expected to rise after December 31st as subsidies expire for most of the 24 million people enrolled in that marketplace. And as part of the U.S. government reopening, the Senate will schedule a vote by mid-December to extend the ACA subsidies for 3 years, although there is no guarantee of this passing in both the Senate and the House. If no deal is reached, health care costs will likely rise, and the chances of a repeat shutdown after January 30th of next year, well, guess what? That can't come back again. So like I said, is there a rotation underway? I got a lot of questions this week about the AI bubble. You've probably been hearing about it. And so technology and AI sectors this past week and really most of November have been underperforming after a very strong rally since April. Consider this, since April, the rally has been about 55% up in the NASDAQ, and that was since the April 8 lows. The technology sector may have been due for a period of consolidation, and maybe some people are actually taking some profits right now. We believe that this is especially true as we head in towards December 31st, year end, where investors think about rebalancing their portfolios, maybe taking some of those profits before 26. And mega cap technology companies are facing challenges from rising debt levels. They are shifting to asset business models, and this could potentially impact the margin and free cash flow. And this is because some of those mega cap technologies who are investing heavily in AI, historically they've been pretty cash rich, but now they're starting to issue a lot more debt to finance these AI increases that are consistently drawing that capital. And we think this trend is particularly concerning in a more debt-burdened company like, say, Oracle. But we're also seeing rising debt levels in companies like Meta and Google. And over time, this could weigh on the profit margins and free cash flows of these companies. And so, again, just be mindful of that as you look at your overall portfolio allocation. With all that in mind and with the volatility that we've seen, what do we think? Well, I expect a gradual recovery in the first quarter and through the remainder of 26. I believe that the lower tax rates that we're now experiencing and going to be able to take advantage of on not only the individual but the corporate level will help. And certainly with the government resuming once again. And so maybe some of this is a little bit overdone in the AI sector. And so that's what you're seeing, these fluctuations, particularly with some of those values just getting very, very high. So what can you do in this environment? Well, I always believe that diversification matters. And certainly over this past couple of weeks and this backdrop, and diversification has held up. And so you might want to use this environment to rebalance your portfolio to your risk level and your income needs that you're looking for. Continue to see that a lot of people have heavy concentration in their company stocks or in ideas that they liked, and now they've gotten so far ahead of where they thought they would be that it's surprising to them. And they just don't know what to do because I think it continues to go higher and higher. This reminds me a lot of the dot-com bust. Some of you may remember that, 2000, 2003. I was lucky or unlucky enough to be going through that with clients at that time and saw lots of people do very similar types of things where the values got to be excessive and they saw no end in sight and they just held on to it all the way down to, well, you know what happened. The other side of that, where a lot of people lost a lot of money. Not that this is the same, but just goes to show you diversification is a good idea. And now with tax rates being permanent, this could be your opportunity to rebalance some of that, take some profits. And if you do it in a smart way, which we'll talk about today during the show, then it won't be so painful to you and you could still get that exposure that you might need to make sure you can live that retirement that you're looking for. You want to stick around for our next segment as I'm going to unveil some last-minute smart money moves that you could be making right now. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman, and you're listening to Protect Your Assets this morning. And people around here, they call me the Sandman. That's because I work hard to find out how you can keep more of what you've worked so hard for. And for those of you just joining us this morning, 2026 is just around the corner, and there is still time to make some smart money moves before this year is over. If you're looking to pay a lot less in taxes next year, don't wait till the last second like you do with your Christmas shopping, because by then it may be too late. You see, the reason I say that is because many of the moves I'm going to talk about today require someone else's help. And just like the post office, and in this case, when you talk about financial assets, each day I am meeting with 2 to 3 clients as we go through their situation and what we can do. And there's only a limited amount of time to make the moves in your account to get some of these done. And sometimes it requires signatures or paperwork or other things we need to do. And that just takes time. And you know what I'm talking about. Everything now takes so long, doesn't it? The backup, it just takes forever, even though it seems like things are much more efficient with the internet. I always scratched my head and said, well, really, is it? So stay tuned and learn what you should be doing now if you want to pay less in taxes next April 15th, as we're sharing today's topic, year-end smart money tax moves to make before it's too late. So what's the first thing you can do? Well, this is easy. Check your withholding. If you received a large tax bill last year, i.e., let's say you owed more than $5,000 of what was estimated, chances are you're not withholding enough. And right now, with the gains we've seen in this year's market, which has been surprising, a lot of the funds are going to start distributing their dividends and capital gains here coming in December, and you may not be prepared for that. So in our office, as you know, we have CPAs and enrolled agents that run simulations, and our advisors are able to do an estimator for you to make sure you're withholding enough. And while there's still time, you can let your employer know to increase the amount of deductions you might want to take from your paycheck before it's too late. What else can you do? Well, you can pay your 2026 bills now. If you plan to itemize, now is a great time to prepay those deductible expenses like mortgage payments, state taxes, medical bills, tuition, rent. If you have a college student under the American Opportunity Tax Credit, well, you can get up to $2,500 per student. What else can you do? Well, the other thing a lot of people wait till the end to do, and I see this all the time, is contribute the maximum amount into your 401k. And you heard me right, non-deductible IRA. What does that mean? You learned something new today. It's probably the easiest and smartest way to save for your retirement. If you're under 50, you can contribute this year $23,500 to your company's 401k plan. If you're 50 and over, you can contribute an additional $7,500 or $31,000 total. And get this year, if you're between the ages of 60 and 63, you can go up to $11,250 for a possible contribution. Get this is not going to count towards your income, $34,750. According to the latest data from the IRS, millions of Americans are still not contributing to their retirement plan. So if you are not on track to maximize fund your plan right now, well, Monday, call your benefits coordinator and tell them you want to max out these plans with any additional capital you have coming your way. This is your opportunity to max out those dollar figures. If you missed what I said, go back and listen to our podcast, or you can replay the amounts and how you do it. Remember, if you do this, your contribution will go into the 401k before tax, and those funds will not be taxable as part of all of your income that you're going to show on your 25 tax return next April. It's really that simple. The more you put in, the less in taxes you're going to pay next year. And that reminds me, did you know that the 401k contribution limit for 25 is $23,500, like I said, for an employee under 50, but the employer can contribute up to $70,000. That's right. So there's the ability for an employer to contribute into your 401k as well. So if you run a small business and you don't know about what I'm talking about, then you need to call me, 866-PROTECT, or you can definitely go to my YouTube channel right now. How you do that is you go to YouTube, type in the search box Liberty Group and David Hollander. Again, at YouTube, Liberty Group and David Hollander. And why I want you to do that is I'm going to show you there how to do what I talk about, a backdoor Roth contribution. This is something that I recently learned, and I'd like to share this with you. Here's a great way to put away more and have it grow tax-free. Get this, no matter how much you make. That's right. It's called a backdoor Roth. non-deductible IRA. Here's what you need to do. Go ahead and open up an IRA account. Make sure when you open that up, you check the box that it's non-deductible, meaning I'm not going to take a tax deduction for the money I'm putting into this account. Put in the $7,000 if you're under 50. If you're over 50, you can go up to $8,000, and you make that contribution non-deductible. It's important you code it that way. Then here's what you do. The next day, hopefully you have a Roth IRA open, but if you don't, go ahead and open it now. Move that money, in my case, that $8,000, move it to the Roth IRA and invest it according to your time horizon and risk tolerance. It's that easy, and now you've got more money growing tax-free for your retirement. Do that over, say, to the next 10 years, and guess what? You'll have, hopefully, a pretty healthy tax-free retirement stream waiting for you in addition to everything else that you just did. Again, if you want to find out more about this, go check out my YouTube channel, Liberty Group David Hollander, and you'll see right there all kinds of great videos, shorts, playlists, and posts for you to learn much, much more. Another favorite for 2025, take advantage of the HSA. I talk about this all the time. I love the HSA. Do you have a high deductible health insurance plan? Also known as an HSA, health savings account. You probably do, and you don't even know it. Again, Monday, call your health benefits coordinator. If you're self-employed, check with your broker. Find out if you have an HSA option. After all, it's after November 3rd now, and you have the ability to change your health care plan up, and I would recommend you do it. Get an HSA with your provider. That's what I do. If you do, you can contribute the maximum amount now for 2025. Here's why. HSA is probably one of my favorite tax gifts to us from the IRS. I call this the triple threat. Here's why. Individuals can contribute $4,300 for 25, and those with family plans can contribute up to $8,550. And if you're over 55 like me, well, throw another 1,000 at it, and now you're at $9,550 this year. That's the maximum amount you can put in, including your employer contribution. This money goes into that HSA tax-free, meaning you don't pay taxes on that money, even though you earned it in 25. Next, if you invest it, the interest or growth is tax-free. And last, it comes out tax-free if you use it for qualified medical expenses. This could include care in your home, activities of daily living when you're older, like cooking, bathing, laundry, things like that. But be aware, once you reach age 65 and are eligible for Medicare, you can no longer contribute to an HSA. So there is a limited window, and if you're under 65 right now, you might want to take advantage of this incredible savings plan. And don't do what John did. John started using that money to start paying for his deductible and healthcare expenses while he was working. That's not the idea here, John. The idea is to invest it just like your Roth and let it grow for years and years and years tax-free, and then use it as your last resort at the end of your retirement to maximize that compounding that goes on there. What else can you do? Talk to a CPA before the end of the year. If last year's tax return surprised you, that's because the tax laws change. And if you haven't done any planning for 25, then now is the time to talk to a CPA or an EA to project the amount of taxes you could owe next April 15th. There could be money owed to the IRS that's due now, coming up here December 15th, if you make quarterly payments. This will enable you to determine if you need to make an estimated tax payment before the end of the year, and don't wait, and that's where a CPA or an EA can really help you. If you like to save on taxes, then I would recommend downloading our free 8-page guide, which you can find on our website at libertygroupllc.com. This is a great way to understand why I make certain recommendations, and you'll definitely ask better questions if you have this guide in front of you when we get together. Asking better questions gives you more confidence in your plan because you understand how all the pieces work together. And that reminds me, if you're like our dear friend Sean, who has been listening to the show for years, you've probably been meaning to call us. I know it hasn't been the highest priority because of all the other things going on right now, particularly with the holidays coming up, right? But why would you want to wait another week? December 31st is just around the corner, and at that time it will be too late for you to do the things I'm talking about today. If you give us a call right now, my team is sitting there by the phone on this Saturday morning, ready to talk to you, ready to help you reduce the taxes you're going to pay next April 15th. It's really that easy. It's painless, it's complimentary, and we do all the heavy lifting. If you want to get a copy of that checklist I just talked about, you don't want to go search for it on the website, call me right now and I'll send it to you. 866-PROTECT. The number 866-776-8328. Again, get that checklist absolutely free right now. 866-PROTECT. Coming up next on Protect Your Assets, it's time for our popular They Say segment, where they say you have to pay capital gain taxes when you sell that stock that you just made all that money on. Is that true? Find out the surprising answer. There's so much more to come. You're listening to Protect Your Assets with David Hollander, the Sandman. That's me. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAevents.com and signing up for our next free event. That's PYAevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I'm David Hollander, also known as the Sandman, and you are listening to Protect Your Assets this morning. And I know the financial investing world can be complex, intimidating. When you throw taxes at it, well, you become frozen. You don't know what to do, particularly with this new big, beautiful bill. There's so many tax deductions and smart money moves you could make. Well, I thought this morning, after I've been working hard these past few weeks going over this with clients, I'd share some of that information with you. And that reminds me, our Tax Smart Retirement Workshops have been completely sold out this past month. Thank you so much for coming out and seeing us. We really appreciate seeing you at the different venues we've been at around the Bay. Due to the extreme demand and all the questions we received, we decided to run, this is a secret, it's a special secret event just for you, to save more money on your taxes this year. If you want to come to, again, these special secret events coming up, we'll be doing them at Trader Vic's and also over there in Marin as well. Go to our website right now, libertygroupllc.com. Click on the events tab, and you can register right there. It is first come, first serve. So do it. Do it now. Now it's time for one of our fan favorite parts of the show. This is our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice. They say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All right, so here's one they say. They say that you always, be careful that word, always have to pay capital gain taxes on your stock winners every time. Is that always true? It's not. Actually, no. You don't pay taxes if you do it correctly. What am I talking about? All right, get ready. If you have the ability to only show $48,475 of earned income as a single filer, or up to $96,950 as a joint filer here in 25, then you could potentially pay you heard me right, no capital gain tax on that stock that you held for over a year and made all that money in this year. So if that's the case for you, or you're just not sure and you have the ability to push income into 2026, then it may make sense to sell your winning investments now tax-free and reinvest back into your favorite company or other companies. And you don't have to wait the 30 days, effectively resetting the odometer on those future gains. That reminds me, both the Dow Jones and the S&P 500 and the EFI index, as we were talking about, are at record highs and have risen substantially this year. So another thing we do, many stock investors, who have experienced gains so far this year, we do something called harvesting, portfolio harvesting, where let's say you sell a stock, you have a gain in it, or you own a mutual fund, which, let's face it, here in April, early December, they're going to start declaring those gains that they realized. This could incur a higher capital gain tax this year for you than last year. Most taxpayers will pay between 15 and, get this, 23.8% in federal long-term capital gain taxes. And California state income taxes are in addition to these rates, which in some cases could be as high as 14.4% just in California. So you could quickly bump your long-term capital gain tax rate from 30 to almost 40% if you sell a stock or an RSU, and let's say it's been held for quite a bit of time. You add to that, maybe you're selling these things that have risen quickly this year. Maybe you bought a bunch in April, realizing the market was down so much, and now you're looking at a short-term capital gain. And for those taxpayers, that will be your ordinary income tax rate, which could be much higher than the long-term capital gain rate when you add it all up. And we saw this, and I want to bring a story to your attention. This was Bob. Bob was a federal employee who was retiring, and he had stock. It was worth over $750,000 in his 401k, and he wanted to pay only long-term capital gain on it versus ordinary income. So when you hold company stock in your 401k, you might have to pay taxes on those investment gains. There's a strategy out there called net unrealized appreciation, NUA. And this strategy could be helpful if you use it during the income gap years, which is that period of time that some people experience once they leave work before they take their Social Security or pension. So let me ask you a question. Do you hold company stock in your 401k or other workplace retirement savings plan? That's the question. Well, as I said, Bob did, and he was all set to call the custodian and ask to roll that over before he heard the show. He was going to move it from a 401k to a self-directed IRA. And so when he called us, I said, Bob, not so fast. There's a tax break that could save you a bundle. It's called NUA. What's NUA? Bob said. Well, NUA, as I said, is the difference between the price you initially paid for a stock, also known as the cost basis, and the current market value, which in this case was substantially higher. Say you can buy company stock in your plan for $20 a share, and you use $2,000 to buy 100 shares. 5 years later, the shares are worth $35 each for a total value of $3,500. $2,000 would be the figure known as your cost basis, and that $1,500 would be this NUA I'm talking about. Why should you care about NUA? Well, when you want to distribute that stock or the cash value out of the 401k, you have a choice. Oh, you do. Roll it into an IRA or another 401k plan. Seems easy, seems logical, but maybe not the best thing to do. You could also distribute the company stock into a non-qualified taxable account and roll the remaining assets into an IRA. The later option might be more effective depending on your circumstances. And here's why this happens. When you transfer most types of assets from a 401k to a taxable account, you're going to pay income tax on that distribution. But with company stock, you pay income tax only on the stock's cost basis, not on the amount you gained since you acquired it. Remember, upon direct in-kind transfer to an IRA, the special NUA tax advantage for that company stock that I'm talking about is lost forever. When you sell your share, you're going to pay long-term capital gain tax rates on the stock's NUA, along with any additional capital gain that occur after you do that distribution. Consider the following 4 factors as you decide whether you might want to do what I'm talking about. Your tax rate. The larger the difference between your ordinary income tax rate and the long-term capital gain tax rate, the greater the potential savings of electing an NUA could be for you. How about absolute NUA? What does that mean? The larger the dollar value of the stock's appreciation, the more the NUA rule can save you on taxes. Consider this one, percentage of NUA. An NUA that is a higher percent of the total market value creates greater potential tax savings because more of the proceeds will be taxed at the lower capital gain rate and less will be taxed as ordinary income. And last, look at your time horizon for your distribution. The longer you plan to keep your assets invested in IRA or a taxable account before you liquidate it, the greater the potential benefit of tax-deferred growth and compounding, and therefore the less you would benefit from the NUA overall. If you're in a shorter time frame, on the other hand, NUA election could be more attractive for you. So let me walk you through what we did for Bob and Jennifer here. After a 40-year career in the defense industry, Bob, who was 67, recently retired with $2 million in his 401k. He's married to Jennifer and currently in the 24% federal tax bracket. About half of Bob's $2 million nest egg is in company stock worth about $1 million. Because he participated in the company's plan for many years and bought the stock at low share price over time, the actual cost basis of the stock was $50,000. While still working earlier this year, Bob, whose recent annual salary was about $100,000 a year, made a $40,000 after-tax contribution to his 401k to buy down the basis of the stock. Under his company's retirement plan, he was allowed to use this money to reduce the baseline value on which taxes would be based, allowing his taxable income to stay in the 24% bracket. When Bob's RMD starts in a few years, he's projected to be in the 22% tax bracket. Again, we used our e-money program to show him that because he had no idea what I was talking about. To take advantage of the NUA after he retired this year, he requested a full distribution of the 401k account, sending the company stock in kind to the taxable brokerage account, and we directly rolled over the rest of that into an IRA. Now he'll only pay tax at the ordinary income rate on $10,000 worth of the basis on the company stock, and he won't be taxed on that gain of the stock, which was valued over $1 million, until he sells it. The other $1 million stays in an IRA, and that can grow tax deferred and be used for all these other things that he may want to do later. You know, if Bob hadn't picked up the phone and asked the question last week when he called in, he might never have taken advantage of NUA. How many of you are wondering about your retirement right now? If you're feeling like Bob, you should pick up the phone and make that call, because Bob made that phone call. He's planning the trips he and Jennifer are going to take next May to Sicily. Bob just picked up the phone and called me. Easy. Coming to my office for a complimentary meeting could change the next 30 years of your life. Think about it. If you're tired of the same old routine, meaning you have lots of questions that keep getting unanswered, and sure, you've made money this year, but so has everybody else. Stop sitting around, settling for less. Pick up the phone. Call me right now, 866-PROTECT. You're paying someone good money to manage your money. Get more, 866-PROTECT. Besides, we have great coffee and free parking. 866-PROTECT. It's time for a quick break, but when we come back, find out how you can avoid having to claim your RMD on your tax return. It's coming up next. Stick around.
If you missed any of Protect Your Assets with David Hollander, all you have to do is go to pyaradio.com, where you can download or listen to our latest shows for free. Just go to pyaradio.com on your computer or mobile device when it's most convenient for you. That's pyaradio.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman, and you're listening this morning to Protect Your Assets. And you've probably tuned in this week to one of the most important shows when it comes to saving money on taxes this year, because we've been talking about the last-minute smart money tax savings moves that you can make right now before it's too late. Let's face it, I know the holidays are almost upon us, and time will just evaporate before you know it. So if you missed any of today's show, then go back and check out our podcast. Wherever you get your favorite podcast, just type in Protect Your Assets, and you'll find out all the smart money tax moves we've been talking about this morning, because this was a good year. Stocks are up, and now's the time to potentially cash in and save money on taxes. And that reminds me, if you're 73 or over, you're probably facing your RMD out of your retirement account. Normally, when you take money out of your IRA or your 401k, it's a taxable event. The withdrawal adds to your taxable income and it inflates your adjusted gross income. Then if you give the same amount to a charity, the charitable gift reduces your taxable income by that amount of the gift, but it does not reduce your adjusted gross income, which could affect things like your Social Security. So let me ask you a question. Do you need your RMD? If you don't, then you may have another option. What is it? Well, you could give it to a nonprofit that you love, like maybe your university or your church, and at the same time pay less in taxes. There's a way to keep the IRS happy and obtain your objectives by fulfilling your RMD duties, and at the same time avoid tax on that RMD distribution. And here's the acronym you need to write down this morning. I'm sorry for all the terms today. QCD distribution. You can give up to $100,000 from your IRA when you are over 73 without counting that distribution as taxable income through a qualified charitable distribution, QCD. A QCD is not taxable income in the first place, so it has no effect on your AGI when you look at your tax return. This is very important because as you get into this phase of your life, itemized deduction phase outs are real. Roth contribution eligibility, the net investment income Medicare surtax, Medicare premium costs, and like I said, don't forget about the taxability of your Social Security income. All of these things are based off your adjusted gross income on your 1040 tax return. Furthermore, giving a QCD directly from your IRA can allow you to benefit from charitable giving even if you don't normally itemize your deductions. Qualified charitable distributions count as IRA distributions and can be used to satisfy all or part of your RMD. This is particularly useful for those who are still working, have a large pension, maybe a lot of rental income, or in general this year, after all these gains in the stock market, find themselves in a much higher tax bracket. To fully count as a QCD, there are three factors that must be satisfied. First, a QCD must come from a traditional IRA. A QCD cannot be made from employer-sponsored retirement accounts like a 401k or SEP IRA. So you still have some time this year to roll over into an IRA rollover before you can take this first step and do a QCD. So remember, the clock is running, and it takes someone else to help you to do this, so get on it. Second, the distribution must transfer directly to a qualified charity. Qualified charity includes 501c3 organizations. The list does not include donor-advised funds, foundations, or other grant-making organizations. And third, you must receive a confirmation letter from the charity, and the letter must include the statement that no goods or services were received in exchange for the gift. Remember, if you do this correctly, the RMD will not count as part of your AGI. In other words, it won't affect your Medicare or your Social Security tax. Picture a day when you don't have to worry about money or taxes anymore. Picture a day when you're standing on a deck in Hawaii looking at the Pacific. The sun is shining brightly. Are you thinking about snorkeling or surfing today? Your wife catches your eye and she thanks you for making all this happen. Picture a day when you can relax, travel, and do all the things you've been waiting to do. It all starts with a conversation. Pick up the phone right now. Call my team. We're live. We're here right now. 866-PROTECT. Again, the number 866-776-8328. Call us before the year is over and it's too late to make any sort of deductions. I'd like to give a big thanks to the Protect Your Assets team for putting together another great show today. Executive producer, network manager Kevin Renfer, and of course all my fabulous producers there doing all the hard work, Danny, Zach, and Nick, because without my team, I'm just another pretty voice on the radio. Thanks again, everybody. You've been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.